Welcome to the UW Now Livestream. Tonight we're discussing the cost of American isolationism with two UW experts from the departments of economics and political science. Assistant Professor Lydia Cox is an economist and an expert on international trade, and Professor Jon Pevehouse will share his expertise in American foreign policy. Our conversation will be moderated by your host, Mike Knetter.
Good evening. Thanks for joining us. What a great night for a trade policy debate, followed by Badger basketball. Living up to his campaign promises, President Trump has been proposing sweeping changes to international policy. In particular, what we'll be talking about tonight is trade policy. And while there's a lot of support for these threats of protection of the U.S. market, there are also reasons that the world has trended toward open markets for the last 40 years. And so we're going to review some of those reasons tonight and get at the why, and then also the causes and possible consequences of our changing attitudes toward protection. Will that really mean America first? Or is America first already because we've had a commitment to more open markets? That's really what we're going to be talking about tonight. So thanks for joining us, and let's get started. I'm going to review a little bit about how we got here, and in particular, the original case for why countries trended toward open trade. Really, why is trade good? Well, it really comes down to the fact that international trade and exchange is voluntary. U.S. firms and consumers that interact with the rest of the world don't do that under duress. Both parties to an exchange must feel better off, or they would not have made the trade in the first place. And so when we add up all the positive benefits that occur from voluntary exchange that we see between U.S. entities and rest of world entities, that's a pretty big benefit that the parties are gaining from that exchange. And so the presumption should always be voluntary exchange is good. And so anyone who comes along and says, oh, wait, there's something about this voluntary exchange that is really harmful to the nation, we should have a lot of questions for them. And it feels to me like we're not holding them to a high enough burden of proof. What are some of the criticisms? The case against voluntary exchange might be, well, the other nation has subsidies. Oh, really? Okay, so their government is actually paying some of the cost of the goods that our consumers are getting for cheap. You might ask, well, how bad is that really? The other nation has barriers against some of our goods. Well, that might be hurting them, but we'll explore how much that really hurts us. The other nation may copy our technology. I think that's a concern that we've seen increasingly in recent years that I'm personally more sympathetic to. I think the motivating factor for a lot of our attitudes toward trade, though, is the existence of bilateral and overall U.S. trade deficits that are often cited as evidence that trade is somehow unfair. And you might say that there's almost a sense that, if our trade deficit were somehow eliminated by more U.S. exports of goods and services, we'd somehow have more jobs, and maybe they'd be jobs in manufacturing. And wouldn't that be great? Well, we'll talk about whether that's really plausible. So let's look at what those bilateral imbalances really look like, and they're pretty substantial. While it's true that trade and investment policies, tariffs, subsidies, etc., are going to shape international exchange patterns, trade imbalances per se don't really tell us anything about whether trade is beneficial to a nation or even whether it's fair. Bilateral deficits between two countries in a multilateral world are really going to reflect specialization and comparative advantage. So Japan is always going to have a big deficit with Saudi Arabia. Japan doesn't have a lot of natural resources, need a lot of oil. So they're going to import that oil from somewhere, and Saudi Arabia is not going to buy enough Japanese manufacturers to make up for that. Obviously, that's not bad for Japan. They need the oil to be the manufacturing powerhouse that they were for many years, and they need to get it from somewhere, and a lot of it does come from the Middle East. Certainly, that doesn't mean Saudi Arabia is being unfair to Japan. In fact, Japan couldn't really do without that. Aggregate national deficits, trade deficits, are a little different and more subtle And what they really mean is that some trade between the United States, for example, and the rest of the world presently involves us, in a sense, exporting assets. That is, foreign entities acquire assets from us. It might be simply US treasuries that they use to manage their position in a dollar denominated trading world, or it could be their investments in what are some really fantastic US companies that have outperformed the rest of the world. And in exchange for those investments, the US is getting more goods and services from foreign countries and not investing so much in their assets. And so you might ask yourself, well, why would that happen? But the important point here is, international exchange is balanced in the aggregate, and a trade deficit is always offset by a capital account surplus. And that is something that's very seldom talked about. We always want to imagine this trade deficit could disappear, and that would only be a good thing. And that's not really true, because the mirror image of the trade deficit are these foreign investments in U.S. assets, which, in a sense, certainly as it relates to U.S. treasuries, provides what has been a longstanding free lunch for the U.S. economy. U.S. year-to-date trade deficits and surpluses, you can see here, we have our largest deficit with China. We have a very large deficit with Mexico. We have surpluses with the UK and the Netherlands, for example. Those surpluses that we have bilaterally are not nearly as big as some of our deficits. And of course, in the aggregate, we have this trade deficit, which is running up annually at or above $1 trillion a year. So that occurs in the context of a world where almost all trade and exchange between countries really does happen within the asset categories and not the goods and services. So international flows are dominated by asset markets, not goods and services markets. But again, for every buyer, there's a seller. So in the aggregate across all transactions, again, the U.S., we're sending things abroad, we're receiving things of equal value, but in every one of those transactions, the recipient of the foreign products views that exchange as making them better off, or they wouldn't have done it. So let's say that aggregate volume of transactions is $1 trillion. All those transactions that go into that made the U.S. entity, firm, household, consumer, better off than they felt they could have been without it. I just went on a trip to Mexico. If I had been told I could only go to Florida or Arizona, I would have been less happy. The weather wouldn't have been as good. I'll just say that. So when we start to segment the transactions by assets and goods and services, we can see that there's a segment of exchanges that you might say are U.S. residents trading their assets for foreign assets. Why would that happen? Well, that's probably people diversifying their portfolios. And you can see there's a segment of the trade that is equivalent value of U.S. goods and services being exchanged for foreign goods and services. We might say that's just ordinary comparative advantage. We're better at some things than the rest of the world, and so they'll buy that from us and vice versa. But there's this range of transactions where we're trading U.S. assets, treasuries, shares of stock, whatever it might be, for foreign goods and services. So let's be clear. Rest of world residents are taking pieces of paper or bookkeeping entries, and we're getting cars, steel, whatever it might be from the rest of the world. And somehow we're worked up about that. Like, we think that's a dangerous thing for the country. And I would just say we should think really carefully about that, because there's probably a reason the rest of the world really wants to buy into our asset markets. And we may not want to buy that many assets from them. So we take goods and services instead. Why is that a bad thing? We should be skeptical about those who think categorically that that's wrong. Why is there this opposition to trade? I would say it's pretty simple. Once you open an economy to trade, some people will win more than others. So all of us win as consumers when we're open to trade and we don't have tariffs, because prices will be lower and we can buy from the lowest cost supplier. So in that sense, everybody wins a little bit from trade. Some workers in the U.S. will gain even more because their products and services are scarce and highly valued in the larger world than they are domestically. So that will increase the price of their products, increase their wages and their volume. The example prime in the United States would be our technology firms. And some workers are going to lose a little bit because their products and services are more plentiful in the rest of the world. And that might put pressure on their prices and wages and volume. And that's probably been true of certain parts of manufacturing, less advanced manufacturing, more labor reliant manufacturing. And it's this concentration of losses in certain sectors that probably creates the really intense opposition to truly free trade and low tariffs. So, this is a chart that I think is kind of instructive, and it shows the share of employment in three different sectors in the US economy going back to 1840. And what you can see is from inception of this chart, agriculture has declined as a share of employment. Manufacturing rose for about a century, and services has risen the entire time. And the point that we're at today is for the last 40 years or so, manufacturing has been declining as a share of total employment in the US economy. And really, that's because, like agriculture, the productivity growth, because of mechanization and robotics more recently in manufacturing and agriculture, has simply been greater than it is in services. And there's a finite demand for agriculture and manufacturing, whereas services demand seems to be potentially less bounded, let's say. So these trends are pretty natural, and I think it's wrong to assume that they're driven somehow solely by trade policy. So, summing it up, the opening of global markets that's been ongoing since the end of World War II has really enabled global specialization and efficiency. It's driven productivity growth and boosted living standards around the world. Countries that did not participate in this have been left behind economically. Think of Albania, countries that really don't trade or open up with the rest of the world. So globalization, however, did coincide with a decline in the share of manufacturing jobs in the US, but it was only one of several factors that contributed to that, technology change being a prime driver as well. The manufacturing share of total output in the US has been much more stable in the face of the declining share of employment because productivity gains have been higher in manufacturing. So there is this parallel with agriculture a century ago, which is what that chart was demonstrating. I'd say tariffs are really unlikely to reverse this. So if the goal of tariffs is to somehow restore employment in manufacturing, I think that's probably a fool's errand. The goal of tariffs may be to threaten tariffs and get better deals, and that's something we'll revisit. And we'll also talk about the details of how tariffs might affect consumers and importers. But in any case, even if we could reverse the trends in employment, where would that employment come from? The US is really at or near full employment since the mid 2010s. And if we're going to grow a sector because of changes in trade policy, that employment's going to come from somewhere. And maybe it would come from the tech sector, and I'm not sure that would be a good thing. So globalization has also coincided with the expansion of the US tech sector. So it's kind of the mirror image of what's happened with these job shifts. So we should really be asking, what do we hope to achieve by breaking the global trade regime? And I'm not sure I've found the answer to that. So that concludes my setup to tonight's program. What we've really got in store for you is some great information about how tariffs actually work, what they do to prices, revenue, and how it affects markets. And I'm going to hand it off to Professor Lydia Cox from the economics department. Lydia?
Yeah, so I wanted to spend a little time just talking about kind of what the effects are of tariffs on the US economy, both for industries and for US consumers. And a good place to start is just, how do tariffs actually work and who pays for them? When a tariff is imposed by the US, it is the US importers, businesses or retailers that are importing the goods that are responsible for actually paying the additional tax to US customs to allow that import to clear customs and actually enter the country. The tariff isn't paid by other countries. It's paid by businesses and people in the U.S. If I'm a U.S. retailer, I'm selling imported steel, which is sold by a foreign company for $700 per ton. If the U.S. imposes a 25% tariff on steel, I now have to pay an additional 25% to actually take possession of the steel import. And you can imagine that means that I'm likely going to try to sell that steel for a higher price in the U.S., passing along some or all of that cost to my buyers, whoever they are. By raising the price of the foreign goods, or the U.S.'s kind of competition for protected products, tariffs allow U.S. producers in protected industries to also raise their prices. So now U.S. steel producers, they're facing kind of less stiff competition from foreign steel producers. They can sell their steel for a higher price. And this makes production in the U.S. of those protected products more profitable, while U.S. consumers face higher prices on both imported and U.S.-made products. And this is the effect that I think policymakers typically intend when they impose tariffs, by kind of insulating domestic industries from foreign competition. It makes those U.S. producers more profitable, gives them a little bit of breathing room, and potentially kind of saves or creates jobs in certain industries. And this is all done at the expense of higher prices for consumers. Now, one thing to note is that the government does collect tariff revenue on the higher priced foreign products, but there is no tariff revenue generated from U.S. producers charging higher prices. The second indirect effect is that because tariffs cause the prices of these protected products in the U.S. to rise, U.S. manufacturers that use those products as inputs into their production now face higher input costs. And this makes their production less profitable and likely causes them to raise prices for the consumers of those downstream goods. So, for example, higher tariffs on steel will raise costs for industries that use steel on inputs like cars and other heavy machinery. And importantly, since the tariffs raised the price of both the imported steel and the domestic steel, all downstream manufacturers are exposed to these higher costs, not just the manufacturers that were using imported steel in their production. So these higher input costs actually make these downstream U.S. industries less competitive against foreign competition. Now, U.S. car producers who are competing against Japanese car producers, the U.S. car producers have to pay these higher input costs while the Japanese car producers don't. So by protecting some industries, it actually becomes harder for other industries to operate. And the third indirect effect isn't something that always happens, but it did during the first round of tariffs that were imposed by the Trump administration, starting in 2018. And it seems like it's likely to happen this time around as well, which is that when the U.S. imposes tariffs on foreign countries retaliate against the U.S. by imposing their own tariffs on U.S. products. And if this happens, it may cause U.S. producers to lose sales abroad, also just making conditions worse for U.S. businesses. So I kind of think of these last two indirect effects, the higher input costs and the retaliation, as the unintended consequences of tariffs. But even though they're just kind of side effects, they can actually do a lot of damage. There has been some discussion kind of alongside of these issues about tariff revenue and the potential benefits of having more tariff revenue, potentially using that revenue to be able to replace some other forms of tax revenue. And while it's true that before the income tax was established in the U.S. in the early 1900s, tariffs were a major source of government revenue. But now the government raises about $2 trillion in revenue from individual and corporate income taxes, but only about $50 billion in tariff revenue. So to even come close to replacing some of this tax revenue using tariffs, first, tariffs would just need to be raised to kind of astronomical levels. But this creates an additional problem, which is that when tariffs increase, we stop importing as much. And this means that as these tariff rates rise or the tax rate rise, the tax base falls, which makes the proposition of using tariffs to replace income taxes or some portion of income taxes really almost impossible. So, we have learned a little bit from kind of past experience with tariffs, in particular the tariffs that were imposed starting around 2018. And what we saw from the first round of tariffs is that on net, US manufacturing employment tends to suffer more from the indirect cost of higher input costs than it benefits from the tariff protection itself. And really, in many ways, this is just a numbers game. In many cases, the size of these downstream industries, the industries that use protected products as inputs into production, just dwarfs the size of the industry being protected by tariffs. In the case of steel, the estimated number of jobs in steel using industries outnumbers the number of jobs in steel producing industries by about 80 to 1, which just means that for every worker that's, imposing steel tariffs potentially benefits, there are 80 workers in industries that will potentially be harmed by these higher steel costs. Second lesson, U.S. consumers, we did see increased prices in the U.S., both for retailers and consumers. And, these higher prices disproportionately impact people who spend a larger portion of their income on imported goods. But we definitely saw increases in prices. And lastly, we also saw that retaliation by other countries did hurt U.S. industries, especially in agriculture. The USDA estimated that the U.S. lost export sales, especially on soybean exports to China, but also on things like sorghum, pork, and other specialty crops. And, the negative impacts of these losses were concentrated in the Midwest, since that's where most of these products are grown. This time around, China has already announced that it will be imposing tariffs on U.S. exports of things like coal, natural gas, and farm equipment. And if the tariffs that have been threatened on Canada and Mexico go through, those countries have also announced plans to retaliate on American beer, wine, fruit, pork, cheese, and other U.S.-made products. And of course, many of these retaliatory tariffs would also hit states like Wisconsin very hard. The best way, at least the way I like to think about tariffs, is that they're a very blunt policy instrument. They have maybe some potential benefits for the industries that are being protected, but they create a lot of collateral damage along the way, which is why economists often kind of warn against their broad-based use.
Thank you, Lydia. I see some questions rolling in already about tariffs, and we'll come back to those after we hear from Professor Jon Pevehouse, who's going to talk about some of the larger geopolitical considerations. Jon, thanks for being here.
Great. Thanks for having me. Some of what I want to walk through tonight is sort of the politics behind, and both Mike and Lydia mentioned some of this, but also talk about this idea that the Trump tariffs are essentially kind of a bargaining chip, and that the reason that he's threatening these is to try to get other things, maybe other economic gains in areas like trade, or that maybe there are broader political gains that, he's kind of threatening these tariffs and is going to remove the threat to get other, like I say, other gains or other wins for the U.S. I want to review kind of the both rounds, sort of version 1 and version 2 of the tariffs. And one of the things I really want to point out here is that, and this is really going to double down on what both Mike and Lydia had to say, the first version of the Trump tariffs in 2018, which he started a couple of years into his administration, were very different than what he's saying he's going to do now. Now, again, we'll see, and I'll come back to this at the end. First of all, the tariffs in 2018, whether we're talking about the ones on China, Europe, the tariffs against Mexico and Canada, were mostly incomplete. What do I mean by incomplete? There were massive holes in them. There was a lot of goods they didn't cover. For example, the tariffs on China did not cover consumer goods. It did not cover electronics. So many parts of the economy in the US on the consumer side were spared, right? Because the tariffs didn't apply to those types of goods. And so many consumers felt the pinch of those tariffs much less. The second thing that happened, and there have been a few economists who have studied this, is that Trump announced these tariffs way ahead of time, potentially 6 months to a year ahead of time. This gave firms a long time to price in those tariffs, to negotiate different deals with their suppliers, to perhaps lower some prices, to say, look, we want to buy the same amount, but you're going to have to lower this because of the tariffs that are coming. So these long lead-ups allowed sort of forward-thinking firms and businesses to adapt to the tariffs ahead of time. That, plus the fact that they were very holy, right? They had all kinds of exceptions to them, meant that, they did not have all of the downside effects that you would normally expect. Finally, Trump did in 2018 use some of these tariffs for bargaining chips. He got rid of them in exchange for other deals with countries. Most prominently, the renegotiation of NAFTA, which we now call the US-Mexico-Canada Agreement, the USMCA. The threats against Mexico and Canada were only removed, these tariffs were only removed after those countries agreed for a revised trade agreement. Just a parenthetical note, because I can't resist about this in the next point. Remember, when the Trump administration is out there saying what a bad deal we have with Canada, Mexico, and China, there's only one administration to blame, and it's the previous Trump administration. And Biden largely continues these, by the way, but we'll come back to that. Right, the China trade deal, right? A lot of the threats on tariffs with China, Trump signs a deal with China China agrees to increase U.S. imports from the United States. China has not abided by that deal that Trump signed, and Biden really did nothing about this, and we'll see if Trump does anything about this. And in the steel sector, Brazil, Argentina, and South Korea agreed to voluntary import quota restrictions. So in other words, they started exporting a lot less steel to the United States to allow U.S. steel importers to compete. So that was version one, right? So kind of mixed bag in terms of the political successes and failures with that. So what do these look like? Well, Trump has been very clear, at least from the outset, that there will be no exceptions to these tariffs. There will not be goods that are excluded. He will not bargain them away for anything but, complete victory in this trade war. Again, this could be a bargaining strategy, which we'll talk about. He's proposed a 25% tariff on Mexico and Canada, which, as Lydia mentioned, would be incredibly costly to several sectors of the United States, and especially the consumer market. We get about 80% of our vegetables and well over 50% of our fruit from Mexico. So that would all go up pretty significantly. The 10% across the board tariff on China, and the Super Bowl proposed 25% tariff on steel and aluminum. There's less lead time. Right now, these tariffs are going into effect fairly quickly, either in weeks or 1 or 2 months, right? So there's less time for firms to adapt, so that could make them bite a little bit more if they are placed. Could this be another bargaining game? It's entirely possible, right? He's already used the threat of tariffs to get concessions from Colombia, dealing with on immigration issues. And he's already delayed the tariffs on Canada and Mexico after the leaders of those two countries kind of, in Mexico's case, agreeing to send more troops to the border, and in Canada's case, agreeing to appoint a fentanyl czar, drug czar in that country. So, some policy maneuvers there. But the one thing I want to suggest, and Lydia and Mike both mentioned this as well, is that the tariffs that Trump's proposing, this is sort of a history of tariffs. And the main thing to look at is just the dark blue line, right? This is the history of tariffs over the since 1821. And as Lydia mentioned, really until the 19-teens, tariffs were the way governments raised money. It's how you funded your military. It's how you funded any social program, right? But then Congress figured out that it couldn't control itself, right? So it turns the right to do tariffs over to the president, because the president's the only universally elected, right, official in the United States. And so Congress knew it couldn't contain itself for all those, to avoid those concentrated costs that Mike talked about. So then you see the yellow line, and this is the across-the-board tariff that Trump's proposing, right? And as this particular nonprofit points out, these would be the highest tariffs since the Great Depression, right? Now, again, maybe this is all bargaining and this goes away, but this is a serious, serious threat. So what are the advantages and disadvantages on the global scene of making these types of threats? The advantages of tools, of using tariff as a tool, is that the U.S. is a really highly valued market, obviously. And this is kind of what Mike emphasized, right? We're a consumer country, largest GDP. We have a lot of buyers in this country. We have a lot of assets. We have a lot of comparative advantage in this country in different sectors. And that gives the U.S. high leverage, right? And so in that sense, it could be a very effective tool. It's also very credible to threaten, right? Tariffs are fairly easy because the president has this control to kind of place and remove, to threaten and remove. That makes it different than, say, for example, a military threat, right? Which tend not to be credible. Are you really going to invade a country because you want a better economic deal or because you want them to change their immigration policy? Probably not, because it takes longer. It's just not as credible. Whereas this tool, the president can far more easily threaten and then back off if they need to. Finally, and this is a little counterintuitive, for all the reasons tariffs are bad, make it more credible, right? If a threat is not costly, right? If a threat is something you would probably do anyway, saying you're going to do it does not impress the other side. Saying you're going to do something that hurts yourself kind of projects the idea that you're very serious, right? And that you really mean business. So the fact that you're willing to risk more inflation, higher consumer prices, means that you could be very serious about this issue. So there are geopolitical advantages potentially to using this as a tool of leverage, but there are disadvantages as well. First of all, as both the previous speakers mentioned, it induces massive uncertainty into markets, right? Buyers and sellers kind of don't know what's going to happen on a day-to-day basis. Are these going to happen? Are they not going to happen? And especially with the slower lead times, the shorter lead times now from Trump, that uncertainty only goes up. If countries don't give in, if these are bargaining tools and countries don't give in, it's costly to the U.S. economy for all the reasons Lydia talked about, right? You get consumer effects, you get bad employment effects. And, other countries may just bet that Trump doesn't want to risk that. And so the downside, so they'll call his bluff essentially and say, fine, put on the 15, 20, 25% tariffs and watch your economy go into a tailspin. I would say also on the geopolitical side, this angers allies, right? Even our allies, as Lydia mentioned, retaliate. In 2018, the European Union retaliated very heavily against the United States, and they retaliated against places like Wisconsin, right? Where they know that already there's a production of goods that are sort of tenuous in the first place. And finally, and I'll come back to this at the end, it significantly weakens the global trading system. But again, as Lydia mentioned, and this is part because of the retaliation, right? States who are not scared to retaliate are going to try to take out use their leverage right back at the United States. As the European Commission President Jan-Claude Juncker said in 2018, we can do stupid too. I want to talk about, and Mike mentioned this as well, like what problem are you trying to solve? Like restoring jobs? This shows wage differentials between Mexico and the United States. Like, do you really think a 25% tariff is going to bring back manufacturing when the wage difference is $5.30 versus $23 an hour? And what the bottom line says is if you've got an employment size of 200 people over a year, that's $6 million. No tariff is going to make up for that. So the idea of, as Mike said, the jobs is just not a good reason. Do you do this to confront China, right? And maybe it's because of intellectual property theft. Maybe it's because they're overproducing steel. Maybe it's because you feel like they are in some ways trying to take advantage of the global economy or take advantage of the United States. The top map shows leading importers in each country in 2000. Notice it's pretty evenly split between the United States and China. In fact, the US probably has the advantage. By the time you get to 2024, last year, the map is almost entirely red. Most states are buying most of their goods from China. So you can imagine politically, the United States wants to do something about this, right? How would you do something about this? Or why would you want to do something about this? Well, what you'd want to do is you'd want to get help from your friends, right? You can't confront China. It's difficult to confront China unilaterally. If they're overproducing and they're stealing intellectual property, they're probably doing that to everyone. Right? So you want your friends, but who are the people? So this map shows people with a positive and negative trade imbalance with the United States. So the red states are countries where the United States has a positive trade balance. That is, in Trump's world, we're, quote, winning against these states. Who have we threatened to tariff? Australia, Brazil, Europe. Now, some of Europe we have a trade deficit with. But in short, the Trump administration is often threatening our friends. Right? These are the people we need to confront China. So if this is a bargaining strategy about confronting China, kind of geopolitics 101 would say you don't then threaten your best friends with trade tariffs. if what the world needs to do is try to confront China and contain them for what is perceived to be their bad behavior. Are you going to address broader political issues? Like maybe you use tariffs and you bargain them away for example, immigration reform or some kind of political reform. This graph shows the projected growth rates over the next 2 years for many of the larger economies in the world. They're not great numbers. They're not awful numbers, but they're not great. And this is Lydia's point about retaliation. So you have to imagine that all the same political dynamics happening in the United States, with people wanting better jobs, with people wanting more manufacturing jobs, with people maybe even for good reasons or bad wanting fewer imports, those are replicated in all these countries. And just like Trump is responding to elections and electors who want these policies, so is the leader of Germany, so is the leader of Italy, so is the leader of the UK, right? Just replicate that in all of these countries that we're targeting. So of course they're going to retaliate. And if those leaders look too weak against Trump, they're going to do the exact same thing, right? And this is why states have an incentive to retaliate. The global economic system is kind of really teetering right now. And the idea that you're going to sort of use a blunt instrument, as Lydia put it, to then put the hurt on some of these countries to get them to behave differently kind of ignores their domestic political situation. And that is one of the huge limits to this trade policy idea. So the World Trade Organization is this broad organization that grew out of the GATT, the General Agreement on Trade and Tariffs, which was formed after World War II. And the way the GATT and the WTO tended to work was that you had these successive rounds of tariff negotiations. And as you can see, they go down, they go down, they go down. So why does everyone hate the WTO, right? The WTO is the most reviled organization in the world, on the right and the left, right? Why does everyone hate it so much? And here you can see a news story from Trump's first term in 2018 saying we may just pull out. And I can already tell you, he hasn't said this yet, but he will very soon. And when he's going to say it is when China sues the United States at the WTO for our tariffs, that they're illegal under the WTO rules, right? And then the WTO is likely to say, yes, China, you're right. And then Trump will say, we're gone, we are out. This is a dangerous situation, right? The world needs the WTO. Does the WTO have problems? Yes. Do people break WTO rules? Yes. But show me a law, an international law or a domestic law that someone doesn't break. That doesn't mean you don't need the law, right? You need this system. One of the main issues with global trade are not tariffs. It's non-tariff barriers. It's kind of subtle ways in which countries interrupt trade and interrupt the trading system. The WTO is there for this very purpose. States sue one another for these things, right? They complain that the trade is unfair, and the WTO has a court which tries to get states to do it. Now, again, it's all voluntary. States can say, you know what? We know we're cheating, and that's fine. We'll pay the fine, right? And so that happens sometimes. But the fact that we know this, that we know these non-tariff barriers are a problem and how extensive they are, is because this organization exists. And what you should never forget, if you're a critic of the WTO, is that what the world looks like without a global trade regime is not everyone's trading fair, everyone's even Steven, and everyone lives happily ever after. It's that large states set trade policy. Large states like the United States are price setters, not price takers, right? And what we're going to see potentially from the Trump administration is the US running the world trade system to our benefit. And so if you care at all how other states work in the global economy, this is an issue. Right. And I think these constant rounds and threats of tariffs potentially move to really undermine the WTO, which, again, like the global economy, is already kind of teetering on the brink.
Great. And we've had some interesting questions roll in. And, Lydia, you had mentioned something about this trade-off between tariff rates and the tariff base, that if we raise the rates too high, the base gets smaller. And Chuck Weiss commented, isn't that same trade-off present with income taxes? And so why is that necessarily a criticism of the tariff as a way to collect revenue if that trade-off exists elsewhere? Do you have any thoughts on that? Or
I guess, yeah, it's a good question. I'm not so much of an expert on how other types of taxes work aside from tariffs, but yeah, I mean, if you believe that people wanted to go out and earn less money because the income tax was getting raised, you would have the same issue. I think with tariffs, we know that the effects of tariffs on trade flows are sizable. So we actually see that happening to a pretty large extent, and I think probably the kind of elasticity of trade flows to tariffs is higher than the elasticity of income to taxes. So I think it may just be the same as income taxes, but to a much more extreme level.
That's right. I think the directional effects are the same, but with the tariff, you have many other alternatives that you can turn to that makes that elasticity different. With income, there isn't always a great substitute for having a job. And so, taxes may go up, but I think the impact on labor supply and work effort is not going to be nearly as pronounced, although Arthur Laffer did get famous for pointing that out, I think. In any case. So Jeff Lyons lobbed in a question about, isn't protectionism more justified when it's used to protect an industry that's critical to national security or somehow supply chain integrity that's related to something that's really necessary for us? Do either of you have any thoughts about that? Is there a different motivation there that's maybe risk management related?
Yeah, I'll just say briefly, it certainly could be. Although if you look at defense industries, they're often highly globalized and highly supply chain dependent, to the extent that it would be difficult to undo that very quickly. Although, again, there is a theoretical argument for that. And yes, in the short run, that certainly could be the case in a time of crisis. And this, by the way, is why, I showed you those tariffs, and Mike showed you the tariffs. The global trade systems brought down tariffs. The exception to that is agriculture, right? And there's domestic political reasons for that, but there's also security reasons. No one wants to be dependent on another country's for food supply. The one criticism I would say of that argument, though, is that, especially in 2018, the Trump administration used national security as the justification for every single tariff almost that they placed, right? They didn't use 242 under the U.S. Trade Competitiveness Act, Section 242. They used national security exceptions. Anything could be a national security exception, right? We're not getting iPhones. That's a security problem, right? And so, and the question is, where do you draw those lines? And I think states have been kind of abusive with the national security language of late, not just the U.S.
We've got a question from Sal Z. Aren't these downsides of protection understood by the administration? And, by extension, I would say, don't all countries understand, like, free trade is good? Economists all seem to, it's like one of the few things, Lydia, that the economics profession probably agrees on. It's not like macroeconomics where there's a lot of disagreement. You could even argue, why do we teach it? Because we don't even agree. But trade policy, I think there's a lot of agreement, but yet it's true. And Jon, you showed this in your final slide. Why is there so much global interruption of trade that's initiated within countries? Why do you think this happens, even though we should all by now surely understand that, openness to trade is in general a good thing and the exceptions should be rare? Why do we see so many exceptions?
I mean, I think it's true that economists are pretty in pretty good agreement about the effects of tariffs. One thing, during the most recent campaign, there was a lot of information kind of being told about tariffs, that tariffs are going to lower prices, that, tariffs are going to bring back jobs. And so in a way, then it becomes, who do you want to believe? Do you want to believe the economists, or do you want to believe, the person who's telling you that tariffs are going to be the best thing for the economy? So I think there is, some of it is, some of that, and there is a part of it, there is a trade-off, right? There is somebody may benefit from the tariffs, and there are these other costs, but you're always weighing, well, do you want to protect one job at the expense of another job? How do you make that decision?
Yeah. Yeah, I think, in my opinion, a lot of it is special interests, so a lot of protection and subsidization is really can be just favors for friends. There's a lot of lobbying that goes on within government, and I'm not saying that a tariff doesn't make somebody better off, right? And you didn't say that either. Tariff will make the protected industry in the local economy better off, and they have a really good sense that they're the beneficiary of that. The costs of that tariff to everybody else through higher prices are very distributed, not well understood, hard to estimate. And so I think it tends to be that there's these very narrow self-interests that can win out in certain cases. And probably in addition, there's this perception again that somehow other people's tariffs are responsible for our trade deficit or the decline in manufacturing jobs as a share of employment in the U.S. I don't necessarily think those things are right, but people can put those things together, and maybe that helps justify it. Ted Olson wondered about, we have such a big deficit with China, and not only do we have this big deficit, like, why do you think our deficit with China is so big, Lydia? And then maybe Jon, can you talk a little bit about intellectual property theft, and is that a real thing, and should we have a different stance with China than we do with everybody else, given the stakes of competition in artificial intelligence and other things? But Lydia, do you have thoughts about why is our deficit with China so big?
The whole, I guess, as you were saying at the beginning, trade happens because it ends up being good for both sides. And so, China has been able to produce a lot of stuff, more efficiently, cheaper than we were able to produce it in the US. And so US buyers want to take advantage of that. And there are things that, we're better at it producing in the US that, are not being produced in other places. So it's really just sort of a matter of what the US wants to buy. There's a lot of stuff that China's producing that the US has wanted to buy. And so that's kind of, as you said, there's kind of two sides to every trade, right? There's a buyer and a seller. I don't know if there's a deeper reason than that as to kind of why the deficit is big with China.
Yeah, I think it's really a lot of light manufacturers and toys and things like that. If we put those tariffs on it, I don't think we're bringing the toy industry back in the United States. It'll move to Vietnam, or it'll go to Thailand or someplace else. But we're not going to start making a lot of toys, I don't think. But and Jon, what about intellectual property theft, and what's going on there, and how does that get resolved?
That's something, it's hard to resolve. It clearly happens, and anyone who's done business in China can tell you that it happens, and can probably cite instances where they've had it happen to them. So it is an issue, and property rights are a big deal to try to protect. Both the Trump and the Biden approach to this previously was to enact things like export bans. So Biden in particular was very aggressive towards the end of his time in office at just banning entire classes of products that cannot be sold now in China out of fear of intellectual property theft. Many of them related to AI, many of them related to things like processors, computer chips. This was in part the origin of the CHIPS Act. This kind of goes back to Jeff Lyons' question two. You have a CHIPS Act in the United States to try to bring home some of that manufacturing in that sector. The problem is it's the same reason import substitution failed in Latin America. If you were good at it, you'd be doing it already. And it's not that we can't become better at it, but the natural comparative advantage just doesn't appear to be with the US in terms of things like technology manufacturers. So what you'd have to get with China is some type of a special agreement with them, I think, a bilateral agreement or something through like a WTO. But then you worry about compliance, right? Just like you would with arms control in the old Cold War days, you can make the agreement, but what's the compliance rate look like? And how you then monitor that becomes a very thorny question.
So Matthias Balmas asked a really interesting question that I think is in your wheelhouse, Jon. He notes we haven't really addressed the full threat of the U.S. isolating itself, which was kind of in our title for the program. Do you think it's possible that if we really carry out some of these threats, that somehow Europe, Canada, and Mexico enter into their own, more substantive free trade alliance and try to, engage more with each other at our expense? Is there any threat of that happening?
Certainly it's a threat. And I think if the U.S. does threaten and actually pull out of the WTO, that's exactly what you could see, is them, these states trying to breathe new life into that on their own. It's not the same, but you recall in 2016, right after he was elected, Trump pulled us out of the TPP, the Trans-Pacific Partnership. And Clinton had promised to do the same thing if she won. There's still a TPP. It exists. It just exists without the United States. And so they're going great guns in Asia right now with trade and surpassing and bypassing the United States in that. So it's absolutely possible that something like that could happen.
Gary Kurtz asked the question, why isn't the stock market reacting negatively to the tariff threats? And obviously the tariff threats aren't the only thing that's happening, and maybe they're just threats. But Gary, I would just say, one of the people I like to follow, Michael Cembalest from JP Morgan, he and his team put together that little research outlook for 2025, and it's titled The Alchemists, which is what, apparently Cembalest, that's the term he uses for the economic policy team that's come up with the strategy. And I'd say, what his subtitle was is deregulation, deportations, tariffs, tax cuts, cost cutting, crypto, oil and gas, agency purges. What could possibly go wrong? And his conclusion is maybe a lot, and maybe we should assume that what they really do want to do is break a lot of entrenched institutions, and maybe some of them need some reform, but we shouldn't forget that the United States sits in a place of global economic leadership for a reason, and we should probably be a little bit careful about some of these institutions that might have gotten us to this position of leadership, and not assume that they're all wrong. But and I would note that Cembalest expects that there will be some pullback in the market this year. Who knows if that'll happen or when? And, I don't think any of us on this program know what President Trump's true motivations are. Is this a form of negotiating? And maybe it is, and maybe all ends well. We could certainly hope for that. I want to be sensitive to the time tonight. I really do want to thank Lydia and Jon for joining us, and our audience for joining us. I know we've got important things coming up at 7:30 Central Time this evening that I want to let everybody get to in case you're watching the Badger game. And so, Lydia, Jon, thanks for taking time out of your busy schedules to talk about this important topic. And I'll close with a cautionary tale about, we should be careful about romanticizing too much. In the 1980s, when I was first studying economics, the business media was certainly convinced that Germany and Japan were going to eclipse the United States as economic superpowers on the basis of their success in autos and steel and some other segments of manufacturing, which they were genuinely good at. The U.S. at the time, there was a lot of concern about losing ground there, and there was a lot of desire for more protection of those sectors. And I would say in the 80s, President Reagan didn't really flinch about that. He was a staunch believer in competition. And what we didn't know at the time is, while all this was happening in autos and steel, the U.S. was building what would become the dominant technology sector in the information economy. And, you really can't have that growth of a new sector like information technology without having some decline in employment of engineers and other talent in other parts of your economy, which in our case probably did involve steel and autos and other sectors of manufacturing. And when you fast forward to today, 7 of the top 10 companies in America are less than 50 years old, measured by market cap. 7 of the top 10. In Germany, that number is 0. The dynamism of the US economy is arguably because traditionally government has favored the consumer over entrenched producer interests relative to what you see in other economies. And I think we would probably regret if we started to cave into doing special favors and protecting certain sectors as a matter of normal business in our economy. It's something we've resisted traditionally, and I think that competition that we allow ourselves to face is part of what has kind of sharpened the economic sword of America. And make no mistake about it, being the technological leader in the world is everything to being the economic leader today and being the military leader. And so there's a lot at stake. And I hope that the US will continue to lead in technology. And I think competition has helped us be that leader. So that concludes our program for tonight. We will be back again with another program next month. I think we're planning to do that on March 11th. And I think we've got a lot going on in government these days. So it'll be very easy to come up with a very interesting and timely topic for March 11th. It's a very fluid situation right now, and look forward to seeing all of you again. And on Wisconsin, go Badgers.